Tonight's topic is real estate in retirement plans. This is a general discussion. So I know a couple of you guys who are uh, clients probably will find this as a refresher course. But one of the things that a lot of our clients are looking at, quite frankly, is taking a second look at real estate. It was a little competitive for a while. It seems to be loosening up a little bit, and we've got a fair number of clients who are actively have sales contracts in. So that tells me that it's loosening up a little bit. So that's good. So people people generally who invest in real estate are investing in real estate outside of their retirement plans. So one of the things that we talk about a lot is the ability to invest in things that you know and that you do personally or in your taxable environment in a tax deferred environment. And that's what a self-directed account allows you to do. The just to go over this again, there are two broad sets of rules in self-directed accounts. One deals with the what you can invest in through the account, and then the other is who the account can transact business with. And the first gate, which is investment options, is pretty broad. The government has a long list of two items that you cannot invest retirement plan money in, and it centers around collectibles. So you can think fine wines, works of art, that sort of thing. And then also, excuse me, life insurance. So those are the two things that you can't do. There are a couple of other things that are we put on the list just to help people out. One is in IRAs, not 401k plans, but in IRAs, the beneficial owner of the account cannot take a loan from the account. That's only available in 401k type of plans. There you go. The other is S corporation stock. And the reason for that is that in order to qualify for sub S status, the shareholders must all be individuals. Okay. And you have to have less than 125 shareholders, which, quite frankly, I think something like 80% of the corporations in the country have less than 125 shareholders. So, but ultimately, though, what happens is you could invest retirement plan money in the corporation, but what'll happen is that'd break the S election, and your other partners would probably be very unhappy about that. So we always put that on the list. And on here also are cannabis assets, and this is starting to become easier to do. And this really is not an issue of uh, the investment per se. This is really banking issues. So cannabis is either legal or in some throes of being legal in probably about 30, 35 states. But the challenge is if you take that money from that investment across state lines, that's money laundering on the federal level because cannabis is illegal on the federal level. So a lot of banks or regulatorily speaking are not wild about cannabis investments. So that's, as I said before, that's kind of loosening up. There's scuttlebutt in Congress to move cannabis from what's called a Schedule One narcotic, which equates it to fentanyl and heroin and coke and all that fun stuff, and moving it to Schedule 3, which would put it on the order of like Benadryl. So if that happens, then I'm sure the floodgates will open up. But in any event, these are the things that you cannot invest in or with retirement plan money. Okay. So the other set of rules deals with who the retirement plan can transact business with. And transact business is any financial transaction. So buy, sell, lend, lease, borrow from, uh, and then a couple of other things. So facilitate, use the assets, guarantee the assets. Okay. So if anybody in this disqualified person group transacts business with the retirement plan, that's a disqualifying event, which means that the account would be distributable immediately. Okay. So these disqualified persons fall into three groups. The first is family members. So if you kind of reach out there in space and put a dot, and if you were to draw a vertical line through that dot, anybody that's on the vertical line is disqualifying. So your ascendants, descendants, spouses. So I wouldn't be able to buy a property in my retirement account from my father, for instance. Okay. I wouldn't be able to rent it to my son, even at fair market value. Okay. And the reason for this, so if you're in a regulated business, a lot of these look like either self-dealing or churning types of transactions. And the reality is the government really doesn't want to get into the middle of discerning whether it's an arm's length transaction or not. And there's issues of moving assets from taxable environments to tax deferred environments and generation skipping and all kinds of fun stuff. So the government just doesn't want to get involved in that. So that's why these rules are in place. The second set of people here are people that are fiduciaries or people that work for the account. So for instance, if your account is with us, I would not be able to buy an asset out of your account because I work for you. I work for the account. So if you have somebody, if you have an advisor that advises you on the assets in this account, then that would be disqualifying if they were to buy that. Okay. And then the third group in tax, there's always there's always the really fuzzy, and this is the really fuzzy. So there's what's referred to as certain other business relationships or certain other relationships. And the best way to really describe this is by example. So if Effie and I are partners in an entity, so we're both partners in an apartment complex, and Effie owns 10% and I own 8%. We are not disqualified with respect to each other. We just happen to be investing in the same thing because between the two of us, we don't control the entity. We can't set policy. We're just catching payments, hopefully. Right? But if, on the other hand, Effie owned 30% and I own 25%, now we are disqualified with respect to each other because between the two of us, we control it. Okay. So you're looking at that issue of control, and then sometimes, um, it's the other thing that comes into play is materiality. So if the investment is a couple $1,000, probably not a big deal. Okay. But apartment complex obviously would be a big deal. So those are the rules. Does anybody have any comments about that or want to? I know I went through it fast. Somebody need more
Effie,
clarification?
Effie did have a question. Can you invest in an LLC that files as a sub S?
No. Okay. So the nuance to this. Okay. So typically, a there's two ways, or there's the way an entity becomes a sub S corporation is that if it is not a corporation, it makes an election to first be taxed as a corporation. Okay. And then it makes a second election for the corporation to be taxed as sub S. So the challenge, though, is that again, for that sub S status, all the shareholders must be individuals. So even if an LLC elected to be taxed as a corporation, which happens a lot, quite frankly, and then from there elects S status, the only way it can achieve S status is for all the shareholders or all the members of the LLC to be individuals. So if there's a corporation or a trust, and by definition, an IRA or a 401k plan is a trust, Okay, that violates the construct. Okay. Anybody else? Okay, all right.
Is one
So,
more, sorry.
mhm.
Ase asked, can my IRA partner with my wife's IRA to buy a property?
The short answer is yes. Okay. The it so I went through the disqualified person rules, and if you go back to if you could show that again for a second, Siobhan. Okay. The the when you're looking at this, remember I said transactions, so buy, sell, lend, lease, borrow. Okay. And these are transactions between the two parties. So in the case of what was the question is you're not really one partner is not buying from the other partner, and we'll have a meet a session on this later in the year because this is a little complex. But really, what you want to do when you set this up is you want to make sure that the two parties, the two IRAs, are investing at the same time. Okay. If they're investing at the same time, then nobody's buying something from the other side, right? You're just merely putting the money side by side and investing at the same time. Now, when you do that, you have to be a little careful in that the money, everything has to be done at the same time. So the investment needs to be made at the same time. If there are distributions that come out of the entity, so typically what people will do is they'll set up an LLC. The two IRAs would invest in the LLC, and the LLC would buy the property. Okay, so all of the running of the property and the operations and all of that kind of stuff is done at the LLC level, not at the IRA level. So when the LLC distributes back to the IRAs, it must do so at the same time. So you can't say, we'll pay some to this partner and then later we'll remit to that partner. Okay. It's got to be at the same time. Secondarily, a percentage of ownership is going to be driven by money in the deal. Okay. So in real estate, and I know many of you guys on the call, since I know many of you, are invested in are real estate investors. And it's not unusual that, maybe Mike and I are partners in a deal. Okay. I'm just money, Mike's boots on the ground. So I might put in 80% of the money, but we split profits 50-50. Okay. Because he's getting an equity share, if you will, for his sweat equity because he's managing it. Okay. Can't do that with IRAs. Okay. The minute that you take two disqualified persons, so husband and wife investing in the entity, they're disqualified with respect to each other. If you skew the percentages of ownership, then one of the spouses is getting the benefit of the other spouse's retirement plan money. Okay. Does that make sense? All right.
No, no, that did not make sense. Can you do that again?
It does.
Okay. Well, here, I'll see if I can do it again. So let's say for the sake of discussion that my wife and I invest. We're going to buy a piece of property. We're going to buy $100,000 piece of property, and I am going to put in $60,000 out of my IRA, and she's going to put in 40. Okay. If we decide to split profits 50-50, then what's happening is my retirement plan is giving her the benefit of 10%, right? So I'm skewing what should ordinarily go back into my IRA, okay, and putting it into hers. Did that help?
Yes, thank you.
You bet. Okay. Anybody else?
I have a
Okay.
Sorry.
different question. I
So
don't know if
that
this is the
deal
right.
has to terminate together as well. One partner cannot pull out and say, I don't want to invest anymore, buy me out.
That's correct.
Okay.
Yep. Because again, if you do that, then
Then you're buying from a,
well, really what I think the way the government would construe that is by the person who is remaining or the retirement plan that's remaining in the entity is giving the benefit to the other spouse for or for paying them out basically. Okay. Effie, did you have another question?
Yeah, I don't know if this is the right time to ask it. It's, you're talking tax, so let me ask the question. If my excuse me, if I have an LLC where the sole member is my 401k, does that LLC need to file a tax return and a K-1? Normally, when it's a single member, you don't do that, but I don't know the answer when it's the LLC, when the 401k is the member.
So it doesn't. So the way LLCs work are single. So for those of you who are um, not versed in this, when you form an LLC, LLCs fall into two groups. They're either multi-member or single member LLCs. If they're multi-member LLCs, they file partnership returns. If they're single member LLCs, they're referred to as disregarded entities. And what that means is that for tax purposes, the LLC will disregard the fact that it's an LLC, and the owner of the single member will pick up the tax attributes of the business or the investment on their tax return. So if I own a single member LLC and it's a rental property, when I look at my tax return, it just looks as if I own the property personally. Okay, I report it on Schedule E as an Edward, and it just becomes incorporated into all the other stuff on my return. Okay, a retirement plan does not file a tax return. Okay, and since it does not file a tax return, there's no tax reporting for the LLC. Okay, on the federal level. Now, if it is located in certain cities, and Kansas City is one that comes to mind, Detroit is another one, they may require an entity to file a tax return, regardless of what its formation is. Okay. So there may be a local requirement to file something. Okay. But there's not a federal requirement. Okay.
Do you know if it's true in Maryland?
Um, no, Maryland, I'm unaware of a city in Maryland that requires that. The state of Maryland doesn't require it.
Okay,
Okay.
thank you. Yeah.
Yep. All right. Good questions. Anybody else want to throw something out there? Okay. So, you know, the we go through a lot of this, and one of the questions that always comes back to me is why would anybody ever want to do this? Okay. This seems like a lot of work. Okay. And the reason, quite honestly, is I think is kind of it's not as it's not very hard. It's kind of simple in that really what you're trying to do is to move money from taxable environments to tax deferred environments. So if you can invest in the things that you like or the things that you know in a tax deferred environment or a tax free environment, you're going to be way ahead of the game. So if you think about this, if I had $100,000 just sitting around in my pocket, right? Not likely, but if I had $100,000 and I invested it, and I was able to get a 10% return, okay, over 20 years. Okay. That would grow in a taxable environment. That 100,000 would be close to $370,000. Okay. If I did that in a tax deferred environment, it'd probably be about 775, almost $800,000. And that's the power of the deferral of that other 30%. So typically, at least in my tax practice, what I see is that people forget tax brackets and that sort of thing. Generally, it doesn't really matter what your tax bracket is. Most people, if you take your total tax and divide it by total income, are somewhere around 25% at the federal level. Okay. So that's taxable income divided by tax. All right. And everybody, most states are they're somewhere between 2 and 10%. The average is usually somewhere around 5. So that's where I get 30%, 25% federal, 5% to the state. So that's 30%. So if I have a 10% return, the taxable or the after-tax return there is 7%. Okay. And that 30% difference over 20 years is almost doubles the value, the account balance. Okay. So instead of thinking of a self-directed account as a retirement account, you should really think of it as a deferred income account. Okay. Because the other thing that's really changing over time is really the perception of what retirement means. Okay. I can, I've been practicing for a long time, over 30 years. And in my tax practice, I can count on one hand the number of people that actually retired, meaning that they didn't do anything. They stopped working, went fishing, hunting, gardening, whatever it is that they're reading books, whatever it is that they like to do. Okay. And typically people who are entrepreneurs, who are basically people who are interested in self-direction, people who are in real estate, okay, never retire. Okay. And again, if I always use this example sort of glibly, but I think it's really, to the point. If you're in real estate and somebody comes to you and says, "Hey, will you sell my house?" Okay. You're not going to sit there and say, "I can't do that because I'm 65 years old." Right? If it falls in your lap, you'll probably do it. Okay. You might not work as hard as you work now. Okay. But you're going to work on your terms. And I think that's really probably a better definition of what retirement is. And that is to work in the manner in which you prefer to work and at the level you prefer to work. Some people, keep going. Others back off. Others, are, have a different model. But it's rare these days that somebody goes from, 100 down to 0. Okay. So if you have streams of income from taxable environments, your work, okay, what I call concentrated assets. So that might be what you do for a living, other taxable investments, and then you have retirement plans. If you're able to invest in things or make investments that you know more about, you are very likely to follow them better than if you just put it in the market and let somebody else handle it. Okay. And again, I kind of go back to my tax practice. It is usually people who are employees, particularly, they look at their retirement plans probably twice a year. Once at the end of the year when they get the big fat statement, and then the other when they're putting their tax stuff together. And that's it. Because we've been conditioned, hopefully there's no brokers on the call, but we've been conditioned to let brokers and investment advisors handle all of that. But the reality is, what do you know about the market? The market goes up and down and back and forth, and it's for most of us, it's really out of our hands. And that doesn't mean that you don't invest there. Okay. It just means that you're probably going to do better if you invest in things that you know about or things that you understand better. You'll probably make more money. Okay. So again, if you're able to do this in a self-directed or in a deferred environment, then that makes a lot of sense. Anybody have any questions of that? Or want to kick that around?
I do, Asyad.
Sure.
So the funny thing, I keep thinking about this IRA, and my 401k only has stocks, and I don't change them. I picked them a long time ago. They're doing all right, uh, and the thing is, whether I own them in my IRA or I own them straight direct, if I don't trade them, if I don't sell them, then there's no tax to defer because there's no event. And if I don't sell them till I retired, it's the same as if they were in the IRA. Uh, the tax is the same.
Well,
And I'm saying that because I hear all my coworkers and they're like, yeah, we just contribute to our 401k and forget it. And if
right.
they're going to do that, the IRA, the only benefit is the initial investment may be a little bit bigger because you didn't pay tax on it.
Well, I think there's a couple of things there. First of all, because the market has generally been going up for a number of years, okay, it's an easy argument to say just put it in there and forget about it and let it build up. Okay. But the day comes when the market crashes. Okay.
Mm-hmm.
The other thing, in retirement, so when you look at marketable securities, okay, does anybody know what the average return on an invest on a stock and bond is? I'm
8% per
talking about
year.
cash. I'm talking about cash, not appreciation.
Mm-hmm.
I'm talking about a cash on cash return, so the dividend. Okay.
Mm-hmm.
The dividend is I saw Mike, I think, had four fingers up there. Okay. That's the return. 4%. The average percentage return on stocks and bonds is 4%. Okay.
Mm-hmm.
So if you are able to live on 4%, that's where the other thing that you'll hear from time to time is in retirement, they talk about the 4% rule. Anybody ever hear that? Okay. And that's where advisors say that the rule of thumb is that you should be able to live on 4% of whatever the retirement plan is. And the reason they say that is because that's the average return on stocks and bonds. Okay. They'll tell you, this is my opinion. I should preface this by saying this is my opinion. Okay. They'll tell you that there's years and years of data and all that stuff behind it. But the hard reality is, you know, it's 4% is the average return on a stock and bond. And lo and behold, that's the number that they come up with. Okay. Um, so I don't know that that's necessarily feasible for a lot of people. Okay. First off, the other thing that you'll hear is you're going to spend less money in retirement. Okay. The reality is most people spend, especially in the early years, they spend about the same amount of money that they spend pre-retirement, post-retirement. Okay?
Mm-hmm.
Because you have the same amount of debt, you have the same amount of obligations. It's very hard to turn a battleship around, right? It takes time. Okay. And then usually what people's spending is, and you'll hear another. This is sort of becoming a little more it's getting a little more traction. You'll hear something about called the SMILE curve. Okay, and what that says is that at the beginning of retirement, you spend about what you were spending pre-retirement, and then you'll dip down, you'll reorganize things. And then as you get older, things start breaking, right? So that spending goes up because you got healthcare costs and assisted living and all those sorts of things. Okay. So the curve looks more like this. But I get back to 4% is hard to live on. So on $1 million, that's 40 grand. Okay. And so people in real estate, I don't know anybody who would accept a 4% cash on cash return on a property. I wouldn't buy a property on 4% if my return was only going to be 4%. And I'm not talking about, depreciation or any of the other things. I'm talking about cash on cash. Okay. So yeah, again, when you're thinking about streams of cash, okay, that's really where self-direction becomes, a winner in a lot of people's minds. Because again, I go back to, if you're investing in things that you know about or things that you have knowledge of, you're leveraging your knowledge, right? So if you want to buy 125 Main Street, you can buy 125 Main Street. Okay. I mean, I have a client, she invests just on one street. Okay. And the reason she does that is because she likes to look through her window 2 blocks away and see her properties. Okay. It wouldn't be my model, but that works for her and she does very well. Well, I mean, we all have one thing about, real estate and we can all attest to this. There's a lot of different ways to make a dollar. Okay. And none of them are any worse or any better than any other. It's your way. And that's the beauty of self-direction. Okay. That answer your question? Kind of, sort of. Okay. Anybody else?
I have a question.
Sure.
So I agree with you. You don't want a 4% return, but as you own properties over the years and as they appreciate, the cash on cash, if you calculate it based on how much equity has now grown in this property, can get down to those kinds of numbers. So what are your thoughts on that? Do you think of it in terms of cash on cash that I invested, or cash on cash based on, if I were to sell it, how much cash is there?
No, it's on the investment, because that's the only money that I've let go of, right? And if I had appreciation or if I had growth in that account, I would probably I'd probably leverage that in some fashion. I might sell that property and I might buy 2 properties, right, and diversify my risk. Okay. But I mean, the reality is, if I invested $100,000, that's the only thing I put into it. If it grew to $500,000, I wouldn't say that my cash on cash return is based on $5 million or 500 million. Ugh. Yeah, I,
I
I wouldn't
understand.
say that it's fivefold. Yeah, it's getting late. I wouldn't readjust the amount of money that I put in there because I didn't put that money in, right? And that's not how, if you're trying to compare to other investments, for instance, and the big benchmark is always the market, stocks and bonds, and that's not how the market calculates it.
Okay, thanks.
Yeah. So, anybody else? Okay. So, the other reason, and Effie sort of alluded to this a little bit, the other reason, that it's, if you're a real estate investor, that if you can get or buy property in deferred or tax-free environments, The other reason it's helpful is because at some point you do get to the point where you're looking to sell property, right? And sometimes it may be the area has turned. It might be that you have an opportunity to buy better property. It doesn't really matter. But if I buy a property for $100,000 and I do really well, and let's just say that you know, short period of time, I double my money. So I sell it for 225. Okay. What's my gain in the property? This is where we participate. What's the gain? Buck and a quarter, right? 125,000. Okay. So if I do that in a taxable environment, okay, what do I pay tax on? I pay tax on 125, right?
Right.
Okay. If I do that in a tax deferred environment, what do I pay tax on?
Nothing
Nothing.
now.
Right, nothing. Right? Because it's all deferred. Okay. So if I sell that and I make 125,000 and I spend $25,000 in the taxable environment, what do I pay tax on?
If you,
I still pay tax on, yep. I still pay tax on 125,000, right? Because I pay tax on the entire gain, right? If I do that in a self-directed or I do that in a tax-deferred environment, I only pay tax on 25,000, which is what I pulled out. Okay. So if you can invest in the things that you know or the things that you like in a deferred environment, okay, you really move from being taxed on production, in other words, everything that you earn, to being taxed on consumption, which is only what you spend. Okay, so you have the ability to mitigate your tax position. Okay, so usually what somebody will say is, well, I could defer the gain. All right. So if I do this personally, I can always do an exchange. Okay. You could. Okay. But it doesn't really help you. You're just kicking the can down the road. Okay. So you don't get a step up in basis in the new property. Okay. Unless you put more money in it. So if I buy that property, we'll go back to my initial example. If I bought the property at 100 and I sold it for 225, first of all, I have to buy something at 225 or greater. Okay. If I buy something at 225, I'm still depreciating based on the $100,000 property. I don't get a step up in basis and I'm able to depreciate 225. Okay. If I invest more than 225, if I say 250, now my basis is whatever the remaining basis in the $100,000 property is plus another, plus another 25,000. So it's not a big boost. Okay. Okay. Um, so, and I can't use the money. Okay. If I pull money out, then that's taxable to me. Okay. If I take less debt than I had, all things being equal, if I lower the debt, I pay tax on the difference in the debt, on the reduction in debt. Okay. So, yes, you do not pay tax currently. Okay. But you're not getting an advantage either. Does that make sense? Okay. Yeah. The other avenue that you have really for tax um, mitigation, let's say, as an individual, is you might take back the loan. Okay, so you might sell or finance. Okay, if you do that though, you're not getting a lot of cash up front. Okay, so if you do that in a tax deferred environment, you have the ability to do with what you want with the money. The other thing actually is there's no time constraints. So I know in my tax practice last year, especially since it was such a seller's market for a long period of time, we had a couple of clients that were doing exchanges and they were running right up against deadlines to be able to reinvest that money. So when you sell a property, if you're doing an exchange, you've got 180 days to place that money in new property. Okay. And there's a couple of other time frames in there. You got 45 days to identify property, and you can only go 5. So there's some other constraints there too. But it was getting a little dicey for some people. So anyway, if you can do it in a self-directed environment, you're probably gives you a lot more flexibility. Okay. Right. So any thoughts about that? Questions?
Question, if I'm over the age of 65, is it still advantageous to invest in an IRA?
Sure. Again, what you're doing when you think about your assets, right? Really what you're doing is you're moving money from a taxable environment to a tax deferred environment. And quite frankly, it doesn't really matter what you're going to do with it. Okay. So if you're going to make your IRA contribution and you're going to do it in, currently, I mean, I don't think age is really, uh, you know, a factor there. I think really what you're doing is you're moving it from a taxable environment to a tax deferred environment. Okay. I don't think age is a factor in that. The only issue is really, do you meet the requirements for being able to make a current year contribution, which is that you have to have earned income. So investment, for instance, if you are just if you're a buy and hold guy, so all you have is rental property, then rental income is not income from a business activity. That's an investment activity. So you're not going to be able to make IRA contributions based on that. Okay. Now you could probably create income in order to do that, but that's a matter for another day. Any other questions on this?
Hi, Jack. You said you moved from a taxable to tax deferred. At what point do you pay taxes if you're
When you
deferring
pull
the
it out.
taxes when you pull it out?
Well, when you pull it out, right. Or you might move it to tax free. So, there are, so I'll give you this is my 30,000 foot view of tax, right? So income falls into 3 buckets: taxable, tax deferred, tax free. Okay. Taxable is basically everything that you do, okay, in your working life. Tax deferred are things like IRAs, 401k plans, annuities fall into this bucket. Okay. And then tax free, you have Roth, there's municipal bonds are tax free. Okay. Life insurance proceeds are tax free. Okay. So you've got things that fall into, or investments that fall into each one of these categories. Okay. So the trick is to move money from bucket to bucket to bucket. So moving it from a taxable environment to tax deferred could be through IRA contributions. If you have a 401k plan, it's making contributions of 401k plan. If you are a business owner, okay, you have a couple of other options. As a business owner, you could have your own solo 401k plan. You could have what's called a simple IRA. You could have a SEP, and all of those have higher contribution limits than just the $7,500 that you can put into an IRA. Plus, you could do the IRA also. Okay, so the IRA is always available to you, and then you could do these other plans. So, if I had a business and I made, I'm just making this up. If my net income was $100,000 and I established a solo 401k plan, I could defer $24,000 into that plan, dollar for dollar. Okay. And then because I'm in the over 50 club, because I got white hair, okay, I'm able to defer another $7,500. Okay, so I'm up to what, 30, roughly 32,000 bucks. Okay. And I can make a profit sharing contribution or a plan contribution of 20% of the net income. So 20% of 100 is 20. So I can put over $50,000 away into that plan based on a $100,000 income. So what I'm doing, is I'm moving 50 grand from my taxable bucket to my tax deferred bucket. And with self-direction, I don't really care what bucket it's in because I can invest in the things that I want to invest in. Okay. So once it's in my tax deferred bucket, with alternative investments, there are always opportunities to move it from a tax deferred bucket to tax free. Okay. So I'll give you an example. Somebody a couple of years ago had a piece of property in their retirement plan. I think it was a condo actually, and it was worth. I think when they bought it for about 200, and they had owned it for a little bit of time, and the tenant had a grease fire in the apartment, in the condo. Okay. So what they did is they went out and they got an appraisal of the property. And the appraisal came back, the first appraisal came back at two and change. Okay. And the client argued with the appraiser, and he said, well, that's an insurance appraisal. And the client said, well, that's not what I asked for. I need an appraisal of what the property's worth right now. Okay. Can't get a certificate of occupancy. There's no kitchen. There's there's no running water because the smoke alarms went off. It was a mess, right? So the next appraisal came back. The true appraisal of that property came back at about $125,000. Okay, the client converted based on the fair market value of the property at the time of conversion, so 125,000. Okay, because it had insurance, right? The insurance company fixed the bulk of what the issues were in the apartment. Okay. So about 6 or 8 months later, property is rentable and worth, 250 or whatever it was worth. Okay. But he paid tax on $125,000 on the conversion. Okay. The true value of that property was really 250, right? Because once it's fixed up, and it didn't really cost him much because it was the insurance company, okay? He had a permanent timing difference there of about $100,000 at least that he'll never pay tax on, okay? Because he was able to pick his shot of when he moved that investment from the tax deferred bucket to the tax free bucket. Okay. So, that's an example though where you're moving investments and money from bucket to bucket to bucket to be tax efficient. And with alternative investments, we run across those opportunities all the time. Okay. Any questions about that? Thoughts?
Well, that's a pretty cool story. I would hate to have to burn my house down, but I'm wondering about the next bucket when you are when you have in your 401k mostly real estate or notes or something that is not liquid and it's time for RMDs, can you, how do you take money out for that, or do you have to make sure you have cash available?
Well, it's you can take assets out if you want. Okay, it doesn't have to, RMDs don't have to be in cash. So let's just talk about RMDs for a second here. So for those who don't know, RMD stands for required minimum distribution. So when you reach the age of 73, you have to start to draw money out of your retirement plans, out of your traditional retirement plans, not Roth. So that's another advantage to being in the Roth bucket. Okay. So the calculation is the fair market value of your assets at the end of the year divided by an IRS divisor. Okay. So the IRS has a table of divisors. Okay. And they're based on life expectancy. So when you turn 73, that divisor is somewhere, I think it's like 27.5. I'm going to say it's 27 something, 27 point something. Okay. So if I had an IRA valued at $100,000, my minimum I'd take the 100,000 divided by 27 and come up with a number. Okay. So that number is going to be somewhere around, call it $3,000. Okay, so that's the amount that has to come out of the account. I can take more, but I have to take at least that amount out. So the first thing is that it's in the early years between 73 and 80, 81, it's generally not a lot of money, number one. Okay, so if you think about my example, you know, on $100,000, it's about $3,000. So on $1 million, it'd be 30,000. Okay. Right. So it's not a lot of money. Second of all, it could be cash. You could take out cash or you could take out assets. Doesn't have to be cash. Okay. So we have clients, for instance, that what they'll do, maybe it's a vacation property. Now, while they're doing this, they can't use the property. Okay. But we've had clients that have distributed out a percentage of the property each year over a period of years. Okay. So what they may have done is they got to get an appraisal. Okay. So maybe in year one, I'm trying to think of one that was done recently. I think the first year the value of the property was somewhere in the neighborhood of $300,000. So they distributed out 10%. And what that looks like is an undivided interest. So it looks like a tenants in common. All right. So they retitled the property, had the property retitled, 10% undivided interest in their name, 90% in the name of the retirement plan. Now, what happens there is that if it's a rental property, which this was, what they did is they went through a management company. So they sort of shifted their model a little bit. They went through a property management company who rented the property, collected the rents, paid the bills, and then remitted out the bottom 10% back to the client because that's what they own now, 90% back to the retirement account. Okay. In year two, when they got the property appraised, there was discounting involved. So the fair market value of the property was about the same, 300,000, but because there was not one owner in the property, now there's two owners, there was some discounting, okay, involved. So, I think the value worked out to be about 260 or somewhere around that. So they kicked out another, I think they did 15% that year. So that might be a strategy for making minimum distributions. The other thing people do is it's very likely that people have retirement accounts, like self-directed accounts, which have illiquid assets in them. Okay. But they also have stocks and bonds and in a Fidelity account or something along those lines. Okay. you're able to aggregate these things together. So you take the value of the self-directed account and the value of the trade, the stock and bond account, whatever the minimum distribution is from both of them, you kind of put that together and you can take that minimum distribution from either account. So a lot of times what people will do is they may take some from the retirement plan, from the self-directed account because it's got some cash in it, but they take the bulk from the trading account. Okay, but generally speaking, if they've got assets that have good returns on them, there's cash buildup in these accounts. So it's generally until you get into your 80s and high 80s, minimum distributions aren't really a challenge. Okay.
Thanks.
Yep. I'll just say one other thing on this. You see a lot of commercials now about converting to Roth, okay, and the tax load that your retirement plan is going to bring you. Um, you know, I I think that's a fair amount of that is the investment companies, the Fidelities and the Schwabs of the world trying to gin up business for themselves. Okay. So, all right. Any other questions on any of these points up to now? All right. Let's talk about how you do this. Okay. So first thing you have to do, obviously, is establish an account which will allow you to buy real estate, like a self-directed account at Mid-Atlantic, always a good place to go. Okay. And when you are looking for property, you want to make the offer in the name of the retirement account. Okay. So you make your offer, and if it's me, I make my offer as in the name of Jack Kiley IRA. Okay. And what we always suggest to people is to also include yourself on that or a business that you own. Many of us do this through LLCs, so I might do Jack Kiley IRA and or Jack Kiley. Okay. And the reason I do that is now I'm a party to the contract, okay, along with my IRA. So as we negotiate terms and we're initialing and crossing things out and adding things on, I don't have to go to the custodian for signatures. Okay. I can do that because I'm a party to the contract, at least initially. Okay. Once you have a ratified contract, send that to us, okay, or your custodian, but you're going to send it to us. And what we're going to do at that point is contact the settlement company and tell them or notify them that an IRA is involved in the purchase of this. Although there are some settlement companies that are well versed in this. There are others that are not. And basically, we're going to let them know a couple of things. Again, first of all, it's a retirement account. It's not you. So that's number one. Number two is that we need to sign the documents. The custodian needs to sign the documents. So we need a copy of them. And lastly, although again, this is becoming less and less of an issue a couple years ago before actually pre-COVID, we wanted to make sure that we got the documents early. So we didn't want settlement companies putting documents together at 10 o'clock in the morning for a 2 o'clock closing, okay? Because we have a process that we have to go through. And the other thing, so once we get a good set of documents, what we're going to do is send them to you, although you've probably already seen them, and you're going to sign off on it because we want to make sure it's exactly the deal that you think it is. Okay. Once you do that, we'll sign the documents, fund escrow, and title will pass to the IRA, not to you. So when you look in the land records, it's going to read something along the lines of Mid-Atlantic IRA, FBO, your name, type of account, IRA, Roth IRA. Okay. And what that tells anybody that's looking in the land records is that you don't own the property personally. Okay. We don't own it. It's a retirement plan that owns it. Okay. As time goes on, if it's a rental property, The rents attendant to the property go back into the account, and the expenses attendant to the property have to be paid out of the account. Okay. That's it. When you go to sell, exact same thing in reverse. So let us know that you're going to sell the property, who the settlement company is. We're going to contact them. Again, there's sometimes they need things from us. We need things from them. When the property sells, the money will go back into your account. And rinse and repeat. So I know I went through that quickly. Any questions, thoughts?
I'm curious if you put your personal name plus your IRA as the buyer on the original contract, and let's say I did that, and I sign the contract. Do I need to sign it as me individually and me as trustee for my 401k?
I don't think so. I think that if the contract says, for instance, Jack and or Jack's IRA, I could do it, the retirement plan could do it, or both of us could do it. Okay.
Yeah.
But let's put it this way. I've never had over the years, I've never had a settlement company say that the client couldn't sign initially.
Okay.
Okay. Anybody else? A quiet group. Usually I got all kinds of stuff going on here.
How
So,
does one handle things when in a rental under an IRA? How do you handle little things like the renter calls, the washer's not working, you go check it out, you put in I don't know, a hose or something, $10, and it's back in order again. Um, that Home Depot item or whatever, how do we handle those kind of things? Because
there's a
technically
couple
we're
of,
not supposed to work at the
right.
house. Yeah.
That's right. You're not technically, you're not supposed to. Okay.
Okay.
All right. So, I mean, typically most real estate people that I know have a handyman or have somebody that does that kind of thing for them. Okay. They'll go out and do that. If you've got a management company, they do all that. They'll do that for you. If you're a self-starter, then maybe you have a friend or something that can do that for you. A lot of times now, when you go back, if you think about the disqualified person metrics matrix that we showed before, okay, and we talked about family members, ascendants, descendants, spouses.
Mm-hmm.
It's one thing that we didn't mention were brothers, sisters, right? So if you've got siblings that are in the area, they could do that for you.
Mm.
Okay, because siblings, interestingly enough, siblings are not disqualified.
So I can do their houses and they can do mine?
Yeah, I wouldn't exactly give it a quid pro quo, but it's
Okay. They can keep track of what they spend on my house and then
well, you can reimburse them, right? Sure.
can I
Yeah, and they'd
reimburse
have
them or
to.
do I need to send
No,
it to
no, no.
you?
The account needs to reimburse them. Right.
Okay.
Right. And a lot of times too, so what we'll see a lot of times too is if it's something that let's say, if you have these sort of unforeseen things that come up in rental properties, right? Well, yeah, the tenant calls and there's an issue in the bathroom. Okay. Those things obviously are somebody's going out and fixing them, and then the account is reimbursing them for that. There's other things that may be foreseen. Let's say that that you've got to repair something in the property. Okay, you might engage somebody that's going to do that, and you've got a contract that's drawn up, and maybe the scope of work you think is going to be somewhere around $5,000, you may advance them, or you submit the bill, and with that, you may advance them, $2,500 or $3,000 out of the account to get them started, because most of these guys
Mhm.
never have money to working capital. So so there we see all kinds of arrangements like that. Good. So
I think Michael, do you have a question?
Yes. My question was about I have a few oil and gas projects that I'm looking ventures that I'm looking into. Would I be able to invest in them through my IRA?
yes, we have a lot of clients that are invested in oil and gas projects. You know, yeah. So typically with the oil and gas deals, you get a packet of paperwork, right? So there's a subscription agreement. There's some paperwork that deals with what's called accredited investors, and then there's the actual um, um, it's not an application, but there's the investment paperwork itself. Usually it's organized as a limited partnership or an LLC, which needs a signature. So the the accredited investor paperwork really deals with you and your financial position, and you would need to complete that component. Okay. And then the rest of it we would complete. Okay. Uh, and then basically advance money out of the account for the investment. So typically we have something we refer to as a bi-direction letter, and that's a it's a form. It's a fancy name for a form that we have, and basically what that tells us is that you are directing us to place or to invest in this case, oil and gas project. Okay, so you would, and we would send that to you. Generally, people call the office, and we'll send that to you. And then you send us the paperwork with the bi-direction, and then we'll, depending on what needs to be done, we'll act on that.
Okay. Would that be done? Would that be better with an IRA or with a Roth IRA?
Well, part of that depends on where your money is, right? And
Mm,
also, I think part
okay.
of it, so people are, it, again, it depends on where your funds are. Now, if you're contemplating converting to Roth, okay, in order to place the investment, okay,
Yeah.
my suggestion would be to probably do that after you make the investment. Okay. And the
Okay.
reason
Yeah.
for that, the reason for that is that, let's suppose that your investment is going to be $50,000. Okay. So you're investing $50,000 for a percentage ownership in an LLC or an LP, a limited partnership, and your percentage of ownership is going to be very, very small in that entity, because these are really big ventures. Okay.
Mm.
So it's probably going to be 1% or less, quite frankly. Okay. I would imagine that if you got that thing appraised, and there's people out there that appraise those, it would come back at less than $50,000. Okay. So whatever that appraised value is, if you converted that, okay, it's probably less than 50,000. And if it's a good investment, it'll pay off more than 50. But all that, again, we're back to that permanent timing difference. Okay. So that's what I would consider, when you're looking at that investment, what is the likelihood that it is, all investments carry a certain amount of risk, right? But what is the, what's the exit strategy, and what does that look like? And if it looks like it's going to be very good, then I might convert on the front end because I know you're going to get discounting. I know it's not going to be worth it's not going to be worth dollar for dollar what you put into it. Okay.
Okay. And can you have more than one IRA or Roth IRA?
Yep. Yeah.
Okay, one for
People
each category,
generally,
like for gold.
well, most people, what they'll
One.
do, most people will have, for instance, their stocks and bonds might be in one IRA. So that might be a Fidelity or Schwab. I mean, we can invest for you in stocks and bonds, but we're not a great venue for that. And no self-directed company is, even though they'll tell you that they are, okay, because they're not broker dealers. Okay, that's not their core business. I'm just being honest. Okay. We have clients, depending on what the content of your other assets are, we have clients that may, for instance, there's a couple of people that own real estate, for instance. They prefer to hold real estate in separate IRAs. So there's a number of clients that will keep one property in one IRA, property two in IRA number two, property three in IRA number three with us. And it doesn't cost any more or any less, okay, as far as administration goes. But what they're doing is they're separating property one from property two from property three, just as you do with LLCs, okay?
Mm-hmm.
Some people do it by states. Um, if you're a multi-state investor. So, there might be reasons that you have to do that. Okay? But that's completely up to you and what your personal situation is.
Okay. All right.
Okay?
Thank you, sir. Appreciate it.
You bet. Anybody else?
Hi, Jack. This is Mark.
Hey,
Can you give me an example of partnering with myself or partnering with my IRA? Is that allowed?
sure. Yeah, it's similar to what the previous question was about partnering, two IRAs partnering together. Okay. Again, you and your IRA are disqualified with respect to each other. So as long as you're not investing or one isn't buying from the other, you're okay. So the construct there is usually to set up an LLC. The members of the LLC are going to be you and the IRA. Percentage of ownership is going to be driven by money in the deal, and then the investment is made into the LLC, and then the LLC does what the LLC does. Okay.
Okay.
But when you look at your statement, at Mid-Atlantic, what you're going to see is not an investment in 125 Main Street property. What you're going to see is investment in the LLC. Okay.
Okay.
All right.
If you do that, and your IRA, your 401k or IRA owns a de minimis, not or 10 or 15 or 20% of the property, could you take the same approach you said earlier by having it appraised and its value is less because there's no I guess management in it, and then transfer that to your Roth?
Yeah. Well, okay. So let me just make sure I understand what you're asking. So if I have it, if my IRA and I are investors in an entity, and maybe I own 80% and my IRA owns 20%. Okay. Um, can I, can I move or convert the IRA portion to Roth? And the answer to that is yes. Right? And you would get an appraisal of the entity, which is really it's really two things. First of all, it's appraisal of the underlying asset, and then there's discounting that would apply because there's more than one owner. Okay, so if I'm looking at buying the property, to me, the 20% interest is not worth that much to me, because I can't, I can't control the property. I've always got to work through another partner. I'm stuck, quite frankly. So that smaller interest is probably going to get larger discounting than the bigger interest, if that makes sense.
Seems like a better thing than burning the house down.
Well, I don't think you burn the house. It's just an opportunity, I guess. But I agree.
Okay.
So, anybody else? All
Jack,
right. Well, no,
Jack,
go ahead. Go ahead.
I'm sorry, Jack. My name is Joanna Fabro, and I came in late. My first question, this is being recorded, am I correct?
Yes, I have
Yes.
it recorded.
Okay, fine, so I can find it. My question to you is that I have an investment property. Part of it is in a self-directed IRA, and the other is in personal funds. Now, the personal funds, if I want to, is there a way that one can shelter that by reinvesting besides a 1031 exchange, by reinvesting it, like in my self-directed IRA that I have now? Or do I have to open another entity, or is there a resolution at all?
Well, unfortunately, there probably is not a resolution. So when you do in an entity, if the partners want to exchange the property, okay, so do a 1031 exchange, it has to be done at the entity level. So for instance, if Mike and I are partners in an entity and he wants to 1031 and I don't want to, he can't take his interest and do one thing and me take my interest and do another, because the owner of the property is not Mike and Jack, it's the LLC. So the LLC has to decide what to do. Okay. So
Now,
the only way that you would really be able to do that is if you distributed out the property, got it retitled as a tenants in common, so undivided interest, and then theoretically the individuals would be able to do their own thing. Although my experience with that is that there is not a qualified exchanger that's willing to take that on, because it's way too much work and it's a pain in the ass. Okay.
thank you.
You bet. Did I hear it? Somebody else had a question? All right. Well, we've been at this for about an hour and a half. I appreciate everybody's time. Please look for our future get-togethers. Siobhan, what do we got coming up?
Next month, we're going over notes.
Okay.
Senior
And
notes.
when is that?
That is at the end of April, April 28th.
Okay. And then for our clients, we do have a client-only event coming up in a couple of weeks, I guess.
Yeah, that's
And
on the
subject.
6th. The 6th,
what's
and we'll
our
be going over UBIT.
UBIT? Okay. And just for those of you who are clients, we do a little deeper dive into that, although we went pretty nitty-gritty into a number of different topics tonight. But I view that quasi-educational, quasi-workshop. If you've got challenges or things, bring them to that. We'll get to them. We'll figure out how to accomplish what it is that you're trying to accomplish. And so keep those in mind. And with that, I will see you soon. If you have any questions, don't hesitate to send them to Siobhan at info@, and we'll get them addressed. Thanks for your time. Good night.
Thank you very much.
Bye.